In this video, we're going to talk about a stop placement strategy of when the market trades above or below a key level. Stay tuned. Hey traders, a very warm welcome to you. So stop losses, so important. We need them to manage our risk, to cap our risk. As I said in previous videos, if you've watched them too wide, what's the point? We're going to be in the trade, but we're going to have to be in such a small position size, it's not worth it for us. Too narrow, you're going to get stopped, death by 1,000 cuts, as I like to say. So one method we have got, which is similar to the multiple day high or low method. If you've seen that video, go and check it out. But it's under or over a specific price level. Obviously, if we're going long, it's going to be under. If we're going short, it's going to be over. What I mean by that, let's talk through it. So when you're taking a trade, the idea is your stop loss is at a point where the premise of the trade is negated. In other words, this trade is no longer valid if this price trades at this level. That's it. That's the whole idea of it. Very simplified, and as I know and as you know, it's easier said than done. But the theory being, if you're buying a breakout, you don't want it coming back. If you're buying a pullback, you don't want it to pull back too far. All those kind of things are going to wrap into a strategy. So let's kind of look at an example here. So an example would be if we're having a fixed price level. Let's say we had a range. Now this may not kind of suit everybody, I'm literally off the top of my head here. Let's say we've kind of got this flag that we think there's a bit of a bull flag, just about on a longer term daily chart. And if you haven't seen the videos on bull flags, guys, go and check them out. Did a good one on the whiteboard. We should go and check it out on the channel. But let's say we just about say this is a bull flag or range or rectangle, probably better. And the traditional thing is we buy a breakout to the high side of that rectangle. Let's zoom in a little bit on this side. So what would we do here? Now, we've got a couple of ways. And in fact, you know what? Let me neaten this up. There's no need to be freehand with this. We've got an actual tool for this. Let's go with our trend line and let's kind of put a line here and say that's the top of our rectangle. Let's put another one here at our low, roughly. It's broadly speaking, it's loose, but let's look at another example in a second. Let's stick with this one. Let's not give up on it just because it's not textbook. So the idea being is we're going to buy a breakout. Let's go long. So where would we put our stop in this? Now, obviously, the obvious place for a stop here is going to be under this level here. Under this level of the low of the range. So we're buying a breakout here, and that will be the stop. Now, obviously, we wouldn't do that if we were just looking for a multi-day move. There's no point in this example as having a $10 stop if we're looking for kind of a $5 target. Most of the time, that doesn't make a lot of sense. Sometimes, in very unusual circumstances, it does, but most of the time, it doesn't. So, we would probably say to ourselves, okay, well, under a key level, why don't we put it just under that last breakout candle, for example? That would make a lot of sense to me. That's the candle that's broken out. Let's say the next day it's gapped up. We buy it on the open. We're saying, okay, we'll go from the low of yesterday. So it's a fixed point in time that we don't want it to go through. Another really good example would be if we're buying a double bottom or double top. And let's stay on Facebook. We may as well while we're here. Oh, I need to get rid of that. I need to put it onto the dragging mode. And a great example is when we're buying a double top we're selling a double top or buying a double bottom. In this case, it's a triple bottom, but let's just assume that we were buying this double bottom down here. The obvious thing would be to have a stop under the low we went to. So as we kind of pushed through the low, that will be an obvious fixed level for a stop. It's not an end day low from previous, it's actually a fixed level. And it's the same as if we already broken through the low. So if we pushed to the low, came back, broke through the low, and you're trading a kind of push back up above, imagine that scenario. That's a very popular one, something I quite like to trade as well. You've already broken through, done a double bottom, but just faked out enough. As you push back up, the logical place to put that stop is going to be underneath that low. That's a fixed level for it. It doesn't matter how many days ago that was, it's just a fixed price level. The low of that plus however many ticks, depending on whether that's a day trade, a 15-minute chart, 5-minute chart, or a daily chart. Another one, let's look at an example if we can find one quickly without us taking too long on here. Let's go with the DAX, German 30, and let's have a look at something like, I'm trying to find something like a, a kind of pullback trade. This will do us very nicely indeed. Okay, so if I drag that over, and let's say, for example, we are buying this kind of break at this flag here. So we've got a big push up, bull flag, a pullback, bull flag, whatever you want to call it. We're buying a breakout of here. The obvious place for us to have a stop is going to be under this little tiny cluster of support here. It makes a lot of sense for it. It's a multiple level of support. We're buying this break with some volume coming through. I haven't got a volume up on the moment, but the assumption is we've got some volume, all the things that we like to see. The obvious level is going to be there. One more example before we move on, guys, is let's say we were selling. Let's have one that we would have got wrong, to keep it kind of realistic with us, because they're not all winners, guy, and how we manage the losers is the whole point of the video, right? Let's say that we were shorting this good resistance level here. Okay, pretty much we know what resistance is. Tag, 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 and let's say we're coming for one more tag and we're shorting it. Now, obviously, this is different to what we just looked at, but let's say that we wanted to be on the short side for argument's sake, because we don't always get them right. Our obvious point for a stop is going to be above, some tick level above that high, whatever that may be. Now, maybe that's a little bit too wide, maybe we want it a little bit tighter, whatever, but the point is it's a finite level and just a few ticks above it. It doesn't matter how long ago it was, it's a finite level. So we're going short on here, our stop is going to be here. We happen to be stopped out in that example, but that's the point. Fixed level where the trade is negated. If that level is going to hold, it's not going to break through. Occasionally you're going to get fake outs. It happens to us all, but if you've got that fixed level, at least you know where you stand. You can set it, forget it. It's a very logical place to put a stop. Anyway, guys, let me know about your method of putting stops. Everyone's different, and I'm interested to learn how you guys do it as well. So share your thoughts and strategies for stop placement. Otherwise, I'll see you in the next one. If you haven't subscribed already, please feel free to do so for more videos from me and other traders on this channel. See you again soon, guys. Take care. Good trading. Bye-bye.